Hello traders, today we want to discuss something amazing, and that is called candle range theory, CRT. So I want to show you on the chart with the practical aspect of it. I know most people out there, they used to show this by giving some candles, but this is a realistic chart analysis using and teaching the candle range theory. So first of all, candle range theory is a trading strategy that is used in forex to analyze market movements. So it is used to know when the high time and the low time of the candle range. So it is used to know the movement within a specific price range. So and this specific price range is defined by the candlesticks. So this is a daily 24 hours time chart, and it is to I want to show you that every day the candle ranges and moves towards any direction. So it's now depend on the direction that the market is moving that you use to take your prediction. So first of all, let me show you. So I'm making this video now on Sunday. So the weekend, the market is not actually active now until tomorrow. So this on the 28th of March. So this on the 28th of March, and if you can see, you look very well at this candle. So this is the highest. So the high time and this is the low time of this candle. So meaning that within these 24 hours the market actually came from the start of the week, this line, the week line, to the bottom line here. So that's where the market actually came. Let me show you again. So this is the highest and this is the lowest here. So now on the daily chart analysis, we now use that candle to know that the market movement is moving in between the two lines that I drew now. So the highest line and the low time. So the market is actually swinging in between, and that's for on the 28th of March. So again, let's see this on the 19th of March. This candle is on the 19th of March, and it's also, so it was moving from here, right from here, from 48.68, from 48.68. The 48.68 is this side. So from it's moving from 48.68 coming. So on the 19th, it's moving from 48.68 here to the low time here. The low time here is 45.01. So that was where the market was swinging, ranging, moving towards the direction. And this the direction it was moving, it was the bearish direction. So now that's on the day trading, 24 hours trading. There are a lot of candlesticks in between this little candlestick that we are seeing here. So let's take this on the 28th for the example. This little candle that we are seeing here, there are a lot of candlesticks in between like that. So now if you go to use a smaller time frame, you see that there are a lot of candlestick there. For instance, 4 hours time frame, or 1 hour time frame, or 30 minute time frame. You see that there are a lot of candlesticks there, meaning that those candlesticks are ranging, so they are giving the market movement. So that's a little bit about the explanation of candle range theory. So then we have key components that we must follow. We are going to use is to discuss about some of the things that you must know in trading your forex by using the candle range theory. So the number one thing is candlestick range. That's the number one thing. So but before we can see this candlestick range, we must go to a lower time frame to see them. So for instance, now let me go to 4 hours time frame. So we have a lot of candlestick here. So we have a lot of candlestick here. So here the market was ranging, here. So these candles, so they are called the candlesticks range. So meaning that each candlestick represents a snapshot of price movement. So all of them, this one is representing one, a snapshot of price movement. This one is also representing one. Every candle is representing the the snapshot of price movements, meaning it's telling us where the price is moving. So then with that, with the body showing primary price action, so the body of the candle is showing the primary price action. That is, people are coming to buy or people are selling. So, but the wick, the body, this is the body of the candle. So I don't know if you can see very well. Okay, let me use this example. This is the body of the candle. You see that big body, so it's the body of the candle. And this tiny line is what we call the tick. So it's also the tick as the wicks also is reflecting the price fluctuations, meaning that if you are trading, let's say from here, so if you are trading here, meaning the price was fluctuating here, so this price actually went up to this level, and it's also fluctuated back. That was a reversal up to this level as well. So meaning that the market was actually fluctuating there. So that's the first thing about the key component of the candle ray theory, which is the candlestick range. Meaning you need to identify and know the candlestick range. So this is for 4 hours time chart. Let me also show you on the 1 hour time chart, because these are the time chart that you use to analyze the bigger time chart. You use the smaller time chart to analyze the bigger one. So here it's also telling us that, so this is the actual snapshots of the price movement. But this week, the week here is telling us that the market was actually fluctuating. So there was bearish up to this level. So the market was coming for a sale up to this. It was selling, and when it got here, it's actually reversed, meaning that it's fluctuated backward. So that is to tell you that the first component of the candle range, the candlestick, the candle theory is that you need to identify the candlestick range. So the next one is multi-time frame analysis. Like I said earlier, we use different time charts to know it. Starting from the day chart. So starting from the day chart like this, you see this the first. So this candle is telling us on the 28th. So starting from the week A, so 47.39 and up to this one, which is 44.76, and that's for the day trading, for 24 hours day trading. Also, we need to also go to 4 hours time frame to check. You see, so it's also telling us that the market was actually ranging downward. So meaning all these candlestick, all these candles, they were arranging like that, so like this. So they were arranging downward. So that is it. With the usage of multi time frame analysis. Also, the next one is to go and check 1 hour time frame as well. Okay, this is already 1 hour time frame, and it's also telling us that the market was the same thing, giving us the same thing, that it was actually ranging like this. That's the same thing. So these are the things that you must put at the back of your mind. You must follow first. So in doing your analysis of the candlestick, the candle range theory. So the next one is the accumulation, manipulation, and the distribution, which we call the AMD, and that one is also under the components of candle rate theory. So what does this mean? It means that the candle rate theory views the market as a continuous loop of these phases, meaning the accumulation, the accumulated time of each candle. So we need to study that. So the time this candle were going downward and upward. So that is that on the component of the candle rate theory. So the next one we want to discuss is how candle rate theory works, how this candle range theory, how it works. So the number one is to identify a higher time frame candlestick and mark its high and low. So we need to go back to 1 hour, like I said earlier. We need to identify, to please follow this instruction. We need to identify the low and the high. So that's the low and the high. for 24 hours time frame. So after that, the candle should preferably be an institutional candle, meaning that institutional candle is telling us that the body must be so high. So the body must be so high than the wick. So the body of the candle must be so high than the wick. So the next one is after the opening of the second candle. So now back to let's go back. I want to go back to 1 hour time frame. So let's use 1 hour time frame to do the analysis. So after the opening of the second candle, switch to a lower time frame and look for a false breakout of the candle. So let's say the market started here on the 28th. So the market started here on the 28th. Coming. I want to look at where it actually started. So the market started on the 28th. The market started here. So now they ask us to, after the opening of the second candle, switch to a lower time frame and look for the false breakout. So when this second candle actually came, so when it came, the next thing that you will do is to go to lower time frame, maybe 30 minutes or 15 minutes or lesser one. So let's check. We are following that instruction deeply. Let's use 15 minutes. Okay, this 15 minutes. Then after that, they ask us to switch to a lower time frame and look for false breakout of the range. So we want to look at the false breakout of the range. So the next thing that we're going to do is also to locate on the 28th. So we're looking on the 28th of March. 28th of March, okay. Let's say that they ask us to, after the opening of the second candle, switch to a lower time frame and look for a false breakout of the range. So let's say the candle actually it was A, and we want to look at the breakout of the range. So you see that the candle was actually going up on the 1 hour time frame that I showed you earlier. So it was actually going up. So now we want to now solidify it by making sure that there is a breakout. So and that breakout, is it a false breakout of the range or not? Definitely here we don't have any false breakouts. The market was actually going up. It was going up. Following the movement, it was going up. So it was going up like that. It was actually, so from here it was going up like this. So then confirm trend reversal by anticipating for a market structure shift. Then when it's reached here, the market actually reversed here, meaning that you can actually make your profit up to this level. And with that, when it got here, so and there was a likely of a little bit reversal. So you must make sure that the market will also come down a little bit. So then it was ranging. Then after that, after the close of the second candle, mark out possible entry points using other blocks. So then with that, we still have to go back to 1 hour time frame again. Go back to 1 hour time frame. So this is the 1 hour time frame, and we're looking for on the 28th. Okay, this was where it was the candle. So this was what was giving us the range that was going up, the one that I marked earlier now. So this was where the market was actually ranging upward here. So there was a breakout up to this level, so up to that level, and it actually came down a little bit. And it was ranging. So just like I said earlier on the 15-minute time frame. So let's go back to 15-minute time frame. It's going to be the same thing. To look for the 20 on the 28th, where the market actually started on the 28th. So it was here. So the same thing. It was here. So this was where the breakout came up to. You see, the same thing that we marked on the 1 hour time frame, but we add the extension of it here on the 15-minute time frame. So up to this level. So starting from here up to this level, it was ranging upward. And when it got there, there was a little bit reversal. So if we go to 1 hour time frame again, we're still going to see that reversal as well. The second candle will determine your entry points, and that's to simply put where your order is going to be picked. For instance, there, so this is the low and this is the high time. So let's say the market is actually starting here. So it's actually starting here. Then the next thing that you're going to do is to look for 15 minutes or 5-minute time frame. So you can just mark that. You can mark your entry points to be around this place. That's this market there. There's going to be a reversal like that. That the market is actually starting to go up like that. So then you need to make sure that it's a solidification. So up to this level. So when the market actually reach this point, that's where you opting for the markets. So that's where you opting for the markets for a buy, for instance. So we opting for buy like this. Okay. So then if you want to take it for a long time, you use 1 hour time frame. It's also here. So we use 1 hour time frame. This is the low. So this is the low of it. So maybe that it's also suggesting that this market is planning to move up gradually. So also the next thing that we can use here is banking on our support line. So banking on our support line. So meaning that it's reached here and these markets can actually go up. Okay. Also on the daily time frame as well, you see that it's also telling us that the support line is actually reaching here. So meaning that this market will actually go up. So for meantime, it will actually go up. So for this daily 24 hours time frame, it can go maybe up to this level within another 24 hours. So it can go up to this level within another 24 hours. So that's that on using the candle rate theory. See you in the next video.